Welcome, everyone. And we're going to get started today with a brief review of a few of the tax benefits that we see coming out of the COVID-19 legislation. We'll get into more details in some of these programs later, but wanted to give you at least a starting point as we begin to discuss what are the proper and what is the best planning approach to taking advantage of these incentives that have been provided in the legislation. Let's start with the refundable and expanded family leave, excuse me, payments from the Families First Act. Now, this is a mandatory provision. So this is, whether you pay these or not, there are some planning elements because there is a possibility to create an exception if you're in the healthcare business, if you're a very small employer. But that's where the planning comes in, as well as the question of whether or not you actually want the rebate here. Now, the concept behind the legislation was employees need paid time off in connection with the COVID-19. Here's how we'll do it. The employee needs the paid time off. You, the employer, pay the employee, and then the feds will reimburse you. And actually seem to have it set now so that the reimbursement can come relatively quickly. But as we will see, there may be circumstances in which maximizing the benefit under the COVID-19 legislation, you may actually want to forego this reimbursement credit. And that ties into the next one of the incentives that we're going to take a look at. And that is the payroll protection plan loans. And this comes out of the CARES Act. And let me note that there will be a webcast next Monday that will go into a lot more detail with respect to how you deal with with this particular provision. Now, and the idea here is we'll have a loan. Loan will be, at least in part, key to what your typical payroll is. And if you preserve that payroll and you continue to pay people at the rate that they have been paid, or at least most of the rate at which they have been paid, then the loan can be forgiven. And this has actually proved so popular that the Small Business Administration has already run out of money and is no longer currently accepting applications for additional loans. Now, one might say, well, okay, we can just move to the next slide. Don't move to the next slide, please. But in fact, although there is some political kabuki going on in Washington, D.C., is frequently the case, I think most observers do believe that we will see a refunding of the payroll protection plan coming relatively soon. And given that, I would urge each of you to continue to include the possibility of applying if you qualify. And you have to have either less than 500 employees or otherwise be Small Business Administration qualified. If you qualify, I would urge you to continue to consider the payroll protection plan loan as a reasonable possibility, and hopefully to be able to use that when it gets refunded by the feds later on. Now, the key elements here, the key element, as we say, is this loan can be forgiven. And we go next to the next slide, and we'll see some of the details there. It is the amount spent by the borrower during an 8-week period after the origination date, and spent in the proper way. To the extent you've done that, then your loan can be forgiven. Now, there are reductions if you lose your number of employees. There is a possibility that credit can be reduced if wages are reduced, but still keep in mind the potential here is a forgiven loan. And by the way, that forgiven loan is not going to be included in income. And the other two items that we talk about are credits, and they will be included in income when they're claimed. In this case, because this comes in at 250% of the amount, it is certainly something that you want to take a look at. Now, let's move on to the last of the employment incentives, and this is on the next slide. We see the employee retention credit. This also comes under the CARES Act. And unlike the reimbursement under the Families First Act or the small business loan, this is one is available to employers without regard to the number of employees they have. And so if you are above 500 employees, if you are not otherwise qualified for Small Business Administration loans, this is probably the one of the three that you will qualify for. You can go directly here and not spend a great deal of time trying to figure out how you get under the other two. But as we look in that, this credit is at most 1/2 of the wages concerned. It also interacts with the other two incentives. If you take the employee retention credit, you are not eligible for the small business loan. If you take the small business loan, you are not eligible for the employee retention credits. Now, we do have some rules that allow you to sort of balance this out. If you've applied for a loan, you have not yet received the loan, can you take the employee retention credit in the meantime? Possibly yes, and then essentially refund it if your loan comes through. Again, keep in mind, this is a credit, and like other business credits, to the extent that you receive it, it has to be included in income. The only one that is essentially free is the ability to have the forgiveness on the payroll protection loan. But as I say, you got to choose between this one and the payroll protection loan. You can't have both. So let's take a quick look now at, and this chart is really, I would say, this hits some of the highlights. And as you can see from the table, the raw numbers do point in the direction of the payroll protection loans. And assuming that Congress does provide additional funding and reopen this program, it will be the preferred choice for many businesses. If it can be accessed, electing not to take the rebate under the Families First Act may well be advisable. Since the Families First Act rebates on a dollar-for-dollar basis, that's the 100%. While the potential benefit of not claiming the rebate is a forgiveness loan of potentially 2.5 times the amount of the foregone rebate. On the other hand, the employee retention credit weighs in at only 1/2 of the amount. And so we would not normally expect a failure to claim or a revocation of the ability to claim a credit under Families First to be beneficial in this case. Now, the maximum benefit per employee, we can see that here. Not every employee is going to generate the maximum under each of the plans. Not every, and it's not going to stay in relation to these three amounts in the case of each employee. So that is an area where you really do have to take a close look at what this would actually mean for the business in under consideration. But as we said, the benefit of both the Families First credit and the employee retention credit is included in income. On the other hand, small business is the target for payroll protection and Families First, whereas everyone has a shot at getting into the employee retention credit. I would say that I'll leave you to the statement that we've got here under the chart. It's got to be done on an individual business basis, and I would urge you to consider all the alternatives in determining what really is the best program. Now, let's move on from the employee incentives and talk about some of the other beneficial items that have come in the COVID-19 legislation. The CARES Act modified or delayed the effective date of a number of revenue raisers that had been included back in the 2017 Tax Cut Act. And specifically, some of these are going to allow certainly amendment of the 2018 return, and if you've already filed your 2019 return, potentially amendment of the 2019 return to generate a refund. Items that you want to take a specific look at: net operating losses. We've gone from no net operating loss carryback with a 90% limit or an 80% limitation, excuse me, to a 5-year carryback without income limitations. So this creates the potential for a 2018, 2019, 2020 loss to be carried back to a higher tax rate year. And that is going to be, I think, a significant benefit for those unfortunate companies that at least are recognizing a tax loss, if not actually recognizing an economic loss. The business interest expense limits. Now, this is only for 2019 and 2020, but the deduction has been increased from 30% of adjusted taxable income to 50% of adjusted taxable income. For those of you on the individual side, the excess business loss limitations have been wiped out for 2018, 2019, and 2020. Excuse me. And finally, with respect to qualified improvement property, this is property primarily in leasehold improvements, in restaurants, in retail facilities. Retroactively, the 15-year depreciable life that got accidentally left out of the 2017 law has been restored, and with that has restored the eligibility for bonus depreciation. Now, a little care with this one: how you file for the refund may determine whether this can be taken as an amendment or whether this has to be taken as a change in method of accounting, which would throw all of the benefit probably onto the 2020 return. But again, that is a detail that I think we'll have to let everyone get into. With that, I'm going to turn things back to Amy, and we have some. First of all, we have a polling question for each of you to get in, and we need this for qualifying for the continuing education. And also, now the rest of the speakers, I think, are going to get into some more detail, not only in how you choose and what you want to be thinking about when you choose among these alternatives, but also how to effectively put that into place in the context, particularly of a payroll system. And with that, Amy, it's back to you.
Awesome. Thank you, Mel. So for everyone that did join us a little bit later, we are doing polling questions throughout our presentation to grant you CPE credit. So if you are looking for CPE credit, we do need you to answer the polling questions. We're going to leave this open for about 5 more seconds as we transition over to Angie here.
Yes, welcome today to our webinar, and we are going to be each of us taking our own little part on how the FFCRA and the CARES Act kind of apply to each one of our areas of expertise. And what we're going to talk about today is the payroll portion of this, because the payroll is covered heavily between all of the CARES Acts and the FFCRA. One of the questions that we get asked is, what is this 941 going to look like come Q2? And what was released today was April 23rd. They're going to be showing the draft of that 941 form. Some things they said to look for is that this form is now going to be 3 pages long, and they're also adding 20 to 21 new fields in this form. So I can't wait to see how they're going to put this in, because I think it's the final piece of our puzzle for payroll. So with this tracking of your payroll, the things that we are encouraging that you have is setting up your earning codes. Set up your software so that it reflects and you're easily able to run a report to help defend or to show that you have anything from the FFCRA to the loan forgiveness to the deferral of your payroll tax payments for the employer Social Security. So with the software setup, we're saying set up your earning code so that you can identify. Right now, this is for the FFCRA, the sick, and if you're paying it at 2/3, and then your child leave. We also want to make sure we draw attention to making sure that you are paying what is the regular rate of pay for your employees, and then also you need to determine part-time hours. What is the equivalent over an average of 2 weeks for a part-time employee? Also within your payroll software, we want to make sure that you set up accruals. Some softwares are not allowed to set up an additional accrual, but if you don't have that option, then an Excel spreadsheet works just the same. And what you can do is we want to make sure that you're listing out your employees and what is the hours that they receive, because it may not be that they automatically get 80 hours. It could be that we have to average that out to what is their working schedule. With the fun and the complexity of the FFCRA, we add in this intermittent leave. And so it's not as simple as they're not here today, they get 8 hours of pay if it's full-time. It can be taken upon agreement with you and your employee that it might be that they're home for 4 hours and working for 4 hours, especially due to the childcare closing or school helping of your children. So just add a little more fun into our tracking. We need to add in the intermittent leave part to this also. Here's an example of a timesheet that we put together that is, helping you try to put all of your documents or recording of them in one spot. So we're encouraging you to list the employees who have sent in a reason why they are on the FFCRA. Is it a sick? Is it a child leave? And then what's their reasons 1 through 6, and then the document that you received. Putting their status, full-time, part-time, and then how many hours do you estimate that they are going to be receiving, in what's over a 2-week period for hours. Then also tracking down in this bottom part of the spreadsheet is showing the rates so that you can defend or show that you paid them at their regular rate of pay or the 2/3. One thing to know is the 2/3 is you still have to pay them at least minimum wage. So make sure that you're watching that also in your spreadsheet. So tracking it in your software, not only do we need to set up information so you can pay your employees, but now we also have to be able to set up our credits and our exemptions so that when we get this 941 released to us, we know how to report it and where to report it. So does your software have the setup for the taxes and the credit? And if not, then that's a conversation you need to have with your software company. And then also knowing that a portion, the forms are already hard enough to fill out for payroll, but now we're having to divide out that these wages paid for FFCRA, that part of them are exempt from employer Social Security wages, but it's not for employee wages. So making sure that you are applying for your credits for the FFCRA and that you are accounting for the wages and the employer share of Medicare tax as part of your credit, and then qualified health plan expense. As we were first anticipating, we thought that you weren't going to be able to get your credit until the quarterlies were filed, but they came back with guidance on this, that you can apply for your credit and offsetting your federal tax payment. And if it's more than that, then you can file that Form 7200. Here's an example of the qualified health plan, because we are getting a lot of questions about how to do this, and we just wanted to go through a calculation and an example on these slides, just so you guys can understand it's not as easy as just taking what the health insurance is for the deduction for the employee on that pay period, that you have to do a calculation for average number of the average daily rate for that health insurance. Here's the example. Well, I'm going to go past this one just so you guys can see it. It was just something for you guys to have in your handout. Here's an example of the tax credit. Just a lot of people are having a hard time understanding the gross pay versus the taxable, and then the exemptions and how it looks. So we wanted to provide you something to help you tie out, like when you have your documentations to support your 7200, if you are filing that, and then also keeping these documents to help support your 941 forms. Here's an example of the 7200. It's not on here, but I want to make sure I point out that Q1 is not listed on this form because we are not accounting for any of the FFCRA on Q1, even though we know we have some interesting dates that they threw out there for the CARES Acts, but everything is going to be reflected on Q2. And the record keeping for our payroll, we want to make sure that you guys understand, and we listed a bunch of documents for you. But the biggest takeaway on this is that it's at least 4 years worth that you need to keep it for 4 years of the documentation for 2020 in relation to your credits for employee retention credit and for your FFCRA. Now we're going to turn over to the CARES Act for the payroll portion of this. Some of the things with the PPP loan, making sure that you're identifying the date that you received that money so that we can start a 8-week tracking for what reports that you need to turn in to try and get that loan forgiven. So making sure that I can identify who is and who is not going to be able to be retained on that report. And that's going to be more back to what Mel said about if you have the FFCRA and you, I'm sorry, I didn't move my office. So if you have the FFCRA, then you don't have to take the credit like Mel stated, is that if you do take the credit, you can't double dip. That's what I'm trying to get to. So if you want to take that money and apply it to the PPP, don't apply for the credit on that tax payment. Pay your full tax payment. The payroll tax deferral part of this, we just want to make sure that you're recognizing that you get to have this deferral, and this goes to all employers, regardless of size. And even now, the PPP loan is actually coming in saying that you can take this credit from March 27th until your loan is forgiven. So making sure that you are doing a reconciliation of each one of your payrolls to show that you are deferring it, because you want to have at the end of the year something that gives you a total, so you know what is going to be paid back 50% on 2021 December 31st, and what is the other 50% that's going to be paid back on December 31st 2022. So we just want to make sure that we also bring into the fact that this one did start March 27th for any tax. And so we're getting questions like, well, how do we put this on our 941? And you can't put on your 941 first quarter because it's going to be deferred to second quarter. Also, that if you didn't pay, or if you have that deferral and then you decided to pay the March 27th, because a lot of people were past this point, that you can catch it up on your next tax payment from the federal, and by reducing it again by the March 27th payment. So you can do a catch up on this. Employee retention credit, Mel went over quite a bit of this actually already with, like here's the eligible employers, qualified wages, the 100 above, 100 below. So even our ACA gets to have a little plug-in with this CARES Act, making sure your FTEs, that we want to make sure that you also identify with this one. It's the same calculation for qualified wages for the health plan. It's the same that you do for FFCRA. It's the same tracking that you'll do for the employee retention credit. And then here's just an example of, how to track it. Same thing if your spreadsheets. I think there's gonna be a lot of Excel spreadsheets that are gonna be happening trying to track this information. But we just want you to understand, how does this credit get applied? And first thing is offsetting your tax payment. If it's not enough, your tax payment took the whole credit plus you still have more, filing that 7,200. That 7,200 is also for the employee retention credit and the FFCRA. So just making sure it's for both. And then this is an example for you guys to see how this applies. Kind of same thing, similar to what Mel has, just making sure you're tracking it to you don't overtake your credit.
Sorry about that. Thank you. And I just want to preface this with, I am not an accountant. I am an HR person. So I'm thankful to Mel and Angie, Anders, and Shannon for their knowledge of the accounting side of things. What I'm going to talk about is the human resource side of things. And both Mel and Angie talked about FFCRA, so I'm not going to go through a lot of details there, but I did provide some information on this slide. The one thing I specifically want to point out is situation 5, which seems to be causing employers an awful lot of grief with regards to an employee being unable to work because they are caring for a child whose school or place of care is closed. And what I wanted to talk about there is that there has been some clarification on these points. And when it comes to childcare, they are referring to both centers as well as in-home daycares, and even if somebody has a family member who typically watches their child and is no longer able to do that, that applies. So that's all I'm going to touch on with regards to this specific slide. What I really want to get at is some of the clarification that we have received relative to situation number 5. For starters, it applies to children under the age of 14. So employees with children over the age of 14 are not eligible for getting the paid leave unless there is a compelling reason why the child requires assistance. For example, if the child is on an individualized learning plan, or if they have a disability that renders them unable to care for themselves or participate in remote learning on their own, then children over the age of 14 would qualify. The next thing I want to clarify is that employers who have under 50 employees are actually able to claim an exemption from situation number 5 if they can prove that providing the leave would place the business in jeopardy. Now, the good news is they don't actually apply for the exemption. It's pretty vague. They simply must document their reason for needing the exemption. And what I would do in that case is encourage employers who want to go that route to document as many details, financial details, the effect on customer service, nature of the job, the impact on the organization overall, those types of things, as many of those as they can, so that if they're audited, they'll be able to provide proof that the business would have been in jeopardy if they had paid that extended leave. And that extended leave to care for a child can be up to 12 weeks. So certainly if an organization is under 50 employees and they want to apply for that exemption, they certainly can do so. Next, I want to talk about how unemployment has changed with regards to COVID-19. More power has been given to the states to determine what, if any, changes to standard unemployment can be made due to the unprecedented situation that we're in. 3 particular things include those who previously could not collect unemployment may now be eligible if their state has implemented this. So that includes people who are self-employed or contractors. The second thing is that states can actually extend the period that an individual can collect unemployment by up to 13 weeks. And then third, a state can also choose to implement the federal pandemic unemployment compensation to provide an additional $600 per week to individuals who are collecting unemployment. And in some cases, what this means is that there are going to be workers who will make as much or more money on unemployment than they did while they were working. And I know that a lot of employers have some concerns that employees may not want to return to work. My hope is that displaced workers will understand that the extensions are only good for a short period of time, and that when things do return to a new normal, the unemployment rate is going to be very high. So there's going to be actually fewer jobs for them to consider, and that if an employer wants to bring them back, they should jump at the opportunity to return to work rather than stay on unemployment. But then again, that's kind of a pipe dream. That would be the best case scenario, but definitely something to consider. So there are things that employers can do if they are considered essential and they have employees that are actually coming into the work location. And some of these things previous to COVID-19 were definitely not seen as doable, but because of COVID-19, they now are. So if an employee says that they are sick, the CDC is asking employers not to require a doctor's note. Right now, doctors just don't have the time to write out doctor notes like they used to for COVID-19 related illnesses. And the worst case scenario would be that you pay under the FFCRA, you pay an employee for 80 hours of the expanded paid sick leave under FFCRA, which trying to go through the hassle of getting them to get the doctor's note is just going to be a little more difficult. So the CDC is asking employers to not have that requirement. Next, if an employee's coronavirus infection renders them unable to work beyond that 80 hours of FFCRA leave, they may still qualify for FMLA if the employer has 50 or more employees and if the employee is otherwise eligible. And to be eligible, an employee has to work 12 consecutive months, and they have to work at least 1,250 hours in those 12 consecutive months in order to qualify for FMLA. You also should keep in mind that if that coronavirus illness extends beyond that 80 hours that they're paid for under FFCRA, that short-term disability might also kick in. So if you're an employer who provides that type of benefit, be sure to check with your short-term disability provider to see how it may apply to someone who has the coronavirus. As an employer, if you're requiring employees to come to work and they do contract the coronavirus, they may qualify for workers' compensation. So be careful about who you are requiring to come into work. And when possible, allow the employees to work remotely. Last, if an employee comes into work, an employer does have the right to take their temperature. So if you are requiring employees to come into work, you can take their temperature. And I would recommend doing that by having employees bring their own thermometer and to check their temperature and to show someone who can either designate that yes, they are cleared to work, or that no, they have to go home. You really do not want individuals who have fevers working, even if they are considered to be an essential worker. So just something to keep in mind there. As employers, you have a lot of decisions to be made regarding your workforce, and you may have the level of work to keep employees busy, but you may need to make some choices where employees either are laid off, you reduce their hours, or they are furloughed. And so I wanted to spend a little bit of time talking about the differences between those three options. First of all, as an employer, you can reduce an employee's hours. And when you do that, you just need to communicate with them because they may be eligible to collect unemployment for the hours that they normally are scheduled to work, but are not working due to the situation. The thing with an employee on reduced hours is that you may keep them on your employee benefit plan even if the number of hours that they work render them not benefit eligible any longer per your company's current policy. You will want to check with your benefit provider on that just to make sure that that is something your benefit provider allows as well. And right now, most benefit providers are being quite lenient when it comes to these things because they realize we're in the middle of a pandemic. Another option is furloughing. And furloughing is where you temporarily suspend an employee's work. So the intent is that you're going to temporarily suspend them from working, but that you plan to bring them back at some point in the future. During a furlough, employees are not paid, so they are able to collect unemployment. And during a furlough, employees are able to keep their benefits, such as medical benefits. You will want to check with your medical provider to make sure that that is the case for them. But as I mentioned, all of the benefit providers that I work with for clients are all allowing furloughed employees to remain on the company's group health plan. The thing about furloughs is that you cannot have your employees working, period. You need to cut off their access to any software systems, email, phone calls, that kind of thing. Because if they work, if they are an exempt employee and you even have them answer one phone call or one email, you are required by law to pay them for the day. And in some situations, you're required to pay them for the full week. Non-exempt employees, if you do that, you have to pay them for every hour that they work. And in either situation, if somebody has been furloughed and you're requiring them to work, it makes things extremely messy for them with regards to collecting their unemployment. So my recommendation is if you know that you want to have someone still stay on a little bit, but not nearly to the extent that their current position offers, reduce their hours. And that way you can call them, you can pay them, they can collect unemployment, but you're not affecting their furlough. The last option would be a layoff, and a layoff is the same as terminating employment. The thing is, with a layoff, they are able to collect unemployment. They will be able to continue benefit coverage through COBRA, just like any other individual who separates employment would. So those are three different options that you could choose if right now your workload tends to be low. There are some other things that businesses need to keep in mind with regards to what we've got going on right now. And now more than ever, it is so important for employees who are working to really step up and do their jobs to the best of their abilities. Employees no longer have, or employers no longer have to keep poor performers. There for a while, there were no qualified candidates out there in the marketplace for employers to choose from. And that is not the case right now. With unemployment anticipated to rise, there are going to be pools of candidates to step into a role if an organization has a need. So handle performance issues, start documenting poor performance, and terminate individuals who aren't meeting your expectations. Another thing you can do is to keep your work environment safe for those who actually have to come into your business location. And you can do that by staggering shifts, increasing the cleaning procedures that go on in your location, furloughing or laying off employees. can be an option, but if you have folks that are coming in, you want to make sure that you're keeping them safe. And if at all possible, allow people to work remotely so that the fewer individuals actually come into the job location. You do want to stay in touch with your employees. Do a state of the business meeting and have your CEO or your president talk with employees about the business and how things are going. If you do have to reduce hours or furlough or lay individuals off, make sure that you have a checklist so that you consistently handle situations and can avoid lawsuits from individuals who might be affected. And then last, check with your benefit providers to see if an employee assistance program or telehealth option is available as part of your benefit packages. Most medical benefit providers, as well as life insurance benefit providers, have employee assistance program or telehealth programs embedded in them. And I can guarantee that employees completely forget about these types of benefits. And yet right now, it's more important than ever that they utilize those. As a wrap up, I just want to make sure that you encourage employees to stay engaged with one another. If they're working from home, or if you only have a few people coming into the office, they're missing out on the social element of being an employee of your organization and working with other individuals, some of whom they might consider friends. So allow time for them to do Zoom meetings, or encourage them to either utilize Zoom or Teams to stay in touch with one another and have those standard break room type conversations. That will allow them to kind of feel a little bit more normal in this crazy time that we're in. And just realize that this is a scary time for everyone. And while some employees may be handling it well, others may not. So things that you can do as a business leader would be to just stay in touch with them and let them know that you're aware of what's going on and provide them with the information about what they can expect. And with that, I am going to turn it over to Amy.
All right, thank you, Lori. And I believe Anders is up next.
Hi, everybody. Thank you. I'm the principal in charge of cybersecurity here at Eide Bailly, and we're dealing with unprecedented times, a lot of transition going on. Many of your organizations have probably interacting with technology much different than you have in the past, and a lot of you probably transitioned a large part, or maybe even some of you, all of your workforce to work remotely. And so we wanted to just take a second and talk about some of the risks, the cybersecurity risks that organizations are having to deal with now that they're transitioning to a lot of remote workers and having a remote workforce. Just as an overview, there's a study that was conducted by a company called OpenVPN, and they talked about some of these risks, and mostly dealing with insecurity incidents, having a security incident rise because individuals and workforce is being done remotely. And so just recognizing that IT professionals are worried about this. IT professionals have concerns with people working remotely, that they do see there's an added risk. So your IT staff, your IT service provider recognizes this. And so just as you're transitioning people to work remotely, be thinking about what you can do to protect your data, because now our data is being handled and transmitted differently than it has in the past. You go on to the next slide here. I mean, we can talk a little bit about what some of these risks are. From a high level, we wanted to just present this presentation, or this diagram, to show you and demonstrate why these remote workers are an added risk. Over on the left side of the screen there, we've got our corporate network, and this is what sort of traditionally where we've operated. All of our data and our transactions internally take place behind a firewall. And so this firewall protects our organization from the internet. We represent the internet as a cloud because it's filled with a lot of things we don't know. There's malicious actors, there are bad things happening, people who want to get our data. And so this firewall has been really there to protect us. But when we hand an employee a laptop and we have them go home and connect via their Wi-Fi, we now create this distance between where our data is and where it needs to reside, where it needs to go back and forth. And it's got to traverse the internet. And again, all these potential risks in just having our data pass through the internet. And so we need to create secure connectivity between the computers that our remote workers are working on, and where they need to get to and access the data. And so we've got to create not only the technology to be able to securely move that data, but also the best practices so people understand that, hey, they've got a role to play. We've all got a role to play in making sure we're working safely when we're remote. So the next slide just kind of goes through some things to consider. These are things you can ask yourselves, have a conversation with your IT service provider or your in-house IT and talk about some of these key considerations. Have you implemented tools for secure connectivity of data transfer? So making sure that that data is being is encrypted as it's going over the internet and it's being secure. What can remote workers do with the data? So if you're accessing financial data from my home computer, well, what can I do with that data? Can I copy it onto a USB drive? Can I move it from one computer to another? Can I post it up onto Dropbox or Google? All these things place your organization at added risk because they're doing something with the data that you've been entrusted with. Have you trained or educated your workforce on how to be secure when working offsite? This is an important step in making sure that employees understand that how they set up their home network now affects the organization, your organization's security and the security of your data. I was talking to one client who we were helping them set up their security at home, and they'd run into challenges because they stored passwords on their computer. They had a password management system. In fact, it was just Google Chrome had always asked them, hey, do you want to save this password? So they saved passwords, even some of their corporate passwords. Well, then their 11-year-old gets on there to play around with the computer, and all of a sudden they've got the password saved in there. It automatically fills it in, and they got an 11-year-old who can access your data. Nothing nefarious, but it's also just kind of like, you got to be careful what you're doing at home. It impacts the organization now. And so making sure you're training employees on how to set up a network and how to work remotely so it can be done securely. The next question is, how do you verify the identities of remote workers when they connect to your system? We relied so much on our physical boundaries of our environment, of our office buildings, and now that's gone. And so we can't just rely on just solely a password. And so look into things. Maybe you've heard the term of multi-factor authentication or dual-factor authentication. This is, we're relying on more than just a password to verify who somebody's identity is. Next, are your employees using their own computers or company-issued computers? So think about, well, if I'm giving someone a company-owned laptop and having them to go home to work on, there's a way that I secure that laptop, and there's ways that I can lock down the information on it. But if I'm having them access my corporate information or my organization's information from their own home computer, well, there's a different method for how you have to connect and make that connection securely, and how you can restrict where that data goes. So just be thinking about which method we're using, and how is your IT organization helping you secure that data. And lastly, what solutions have you put in place to secure email from malicious actors? Just an important reminder that email is not a secure method of data transfer. Once an email leaves your corporate environment or leaves your email system, it's going to a customer, it's in clear text. And so if you're transmitting sensitive information, you got to make sure you're providing tools for that secure communication of email and secure email. Maybe one more thing on there. I didn't put it on here, but we've got a lot of questions about Zoom and Zoom bombing. You probably have heard things about that, where Zoom sessions will get hijacked, and people with malicious intent will get on there and post some inappropriate pictures or have some commentary that's inappropriate. And one thing we try to encourage clients is that there's nothing to be afraid of with Zoom. Zoom can be secure. It just has to be set up securely. And so it's a great tool to be able to help customers and employees feel more connected, because you're visually being able to see someone there. So setting up Zoom securely is key. And I'll point I'll provide a couple of links through Amy here when she sends out these slides. Zoom has a website, zoom.us/secure or security. It provides some guidance on how to set up a secure Zoom session, and also Forbes had an article on how to securely set up a Zoom session. So I'll make sure those links get sent out with these slides so you have that information as well.
Thanks, Amy. I'm going to cover the international tax implications related to what is happening right now in our environment. Under the CARES Act, there are a number of provisions that could have implications for internationally focused companies. The first one is the 5-year carryback for NOLs after 2017. There's temporarily removing the 80% limit on NOLs, the increasing of allowances for business interest deductions under 163J, and then the change to clarifying the qualified improvement property costs as well. And all of these things seem to mean good news, but you do need to be cautious if you have international operations. In explaining this, we'll talk a little bit about how those international provisions come into play with some of the CARES Act provisions. So for 2018 to 2025 years, there's GILTI income that's being taxed at 10.5% after the Section 250 deduction. And domestic net operating losses operate to reduce the Section 250 deduction. And then the foreign tax credit is allowed up to 80% of foreign taxes paid, but no carry forward or carryback is available for excess credits related to GILTI income. So with the 5-year NOL carryback and how it interacts with GILTI, the domestic losses offset GILTI under current law. If prior year GILTI is offset by an NOL carryback, then the value of the carryback will be reduced because GILTI was only taxed at 10.5%. So let's say if your GILTI was in a year that is the rate's 21%, you would think that you're going to get a benefit of 21%, but you're not. And then if foreign tax credits were used to offset the 10.5% that was left over, these are also no longer of value as they can't be carried forward. So one example, just a high level example, is a deductible loss would generate tax savings for a corporate taxpayer equal to 21% if they didn't have GILTI income. So that $10 loss would expect to save $2.10. A taxpayer with $100 of GILTI, however, and a $10 loss would save only $1.05 in tax as a result of the limitation under Section 250A2. And a taxpayer that had a foreign tax credit related to that GILTI income could also just lose the benefit of that foreign tax credit going forward. So you need to be very careful about how those items impact each other. And taxpayers are allowed to, related to the Section 965 income inclusion, deemed repatriation tax, you would know if you were subject to this for sure. It was quite painful. Taxpayers are allowed to forego the use of losses, the net operating losses against Section 965 income, the inclusion income, subject to tax at reduced rates. The reason for this is that 965 income was taxed at a much lower rate than the normal rate. So this is actually a very good thing for taxpayers if they wanted to forego that. One thing to note about Section 965 is that many taxpayers would think that they would be able to receive a refund on the NOL carryback for that 965 inclusion year. But the IRS currently is not allowing that. What they are doing is they are applying that refund to the 965 payments that you were carrying or paying over 8 years. One other item that impacts international companies is the business interest expense. So for tax years beginning in 2019, interest expense was limited to 30% of the adjusted taxable income. That's been increased to 50% under the CARES Act. The taxpayers that recognize the NOL in 2019 and 2020, that also will increase the NOL. So keep in mind that if you are increasing the NOL, then you also have the additional issue of that being offsetting GILTI income as previously discussed. There are also some BEAT interactions. BEAT is a term for essentially a minimum tax on intercompany foreign related party payments. And the NOL changes are likely to create a lower regular tax liability, and this could increase the likelihood of a BEAT liability related to related party payments. Also, that additional interest deduction under 163J also has the potential to reduce the regular tax liability and therefore increasing BEAT liability. So you'll want to definitely take a look at how that interaction plays out. Finally, on all of these, many countries are putting in place incentives, different provisions that help businesses similar to what the US is doing, including NOL carrybacks and increased interest deduction provisions. Do keep in mind that if you have a foreign tax redetermination because of an NOL, then you're required to file an amended return to reflect that reduced foreign tax. So you'll want to definitely keep track of those if your company has taken advantage of those types of things, to also be aware of the impact on your foreign tax credit. Also, there was a provision that doesn't seem to have much international impact, but it does. There was a change or a clarification to qualified improvement property. This is relevant in international tax concepts because we use for international provisions the ADS life, which means basically that we're straight lining over a number of years, which is usually longer than regular depreciation for US tax purposes. And the ADS life for the qualified improvement property will change from 40 to 20 years. So for assets placed in service in 2018, the change could be made on an amended return or through a method change. So you want to look at that as well for purposes of your calculations such as GILTI and FDII. So this is just an overview of what companies can consider where there's a foreign company that has a US business operation. If there is, oftentimes there's intercompany interest deductions. So the interest limitation of 163J being increased, you could consider filing a return to request a refund of overpaid estimated payments to take advantage of that 50% limitation for 2019. For companies with 100 or less employees, the adjusted estimated payments for 2020, you can consider the employee retention credit of 50% of wages. For companies with losses, 2018 through 2020, of course, consider filing those returns to take advantage of net operating loss carrybacks. And then related to the PPP loan, of course, it's not being funded currently, but it potentially will be again, as Mel mentioned. Keep in mind that US companies with foreign owners also are eligible for this loan. However, you do need to look at the entire ownership structure when you're counting the 500 or less employees. So something to look at if we get additional funding for that. And for companies with expat employees, definitely consider the residency status in both the home and host countries, given that there have been so many travel restrictions. Some individuals may be in a country that they weren't expecting to be in. Also looking at the payroll tax implications for both the individual and company. If they're reimbursing employer expenses for temporary or permanent transfers, as well as quarantine expenses. And then also looking at the company's policy and treatment on issues such as fairness and tax equalization. So a lot of employers are equalizing tax for individuals. Maybe they don't have this in place now, but the individual is likely going to become taxable when they weren't expecting to, and making sure that the tax equalization can be done, or whether it should be done, is important to consider as well. And then for US companies with foreign business operations, one thing that they should consider is that this downturn does provide some opportunity to look at a stock loss deduction on insolvent foreign subsidiaries, potentially even a bad debt deduction for intercompany loans to insolvent subsidiaries. So sometimes these types of events can become triggering events for those losses. And then whether those losses can also be used to take advantage of the loss carryback for 5 years. Then NOL loss carrybacks, we talked about this in depth, impacts GILTI and FDII, so please be aware of that and be cautious of that. There have been some commentary about changes to customs and duties and opportunities related to that. I would encourage you to look into that as well. And then also reviewing the profitability by jurisdiction and making sure that's in alignment with where the functions and risks are. and how that relates to your transfer pricing policy and methodology. Also, we have some considerations for individuals, for U.S. citizens that are living and working abroad, looking at whether these permanent or temporary relocations or where you can't leave a certain place could change your immigration status, your tax residency status, and other tax filing positions. There's a lot of uncertainty for individuals, and we're hoping that we will get some reprieve on our ability to claim, for instance, that there's a health issue and therefore the individual can't leave and leave the country and may not have to claim that they're a resident. Keep in mind there are payroll and income tax implications for both the home and host country related to employee relocations, reimbursed employment expenses. And then many taxpayers will soon be receiving the recovery rebate payments based on the filing of prior year tax returns. Recovery rebate payments to individuals who are previously or currently on an international work assignment may be impacted by such work assignments. And for resident and non-resident aliens living and working in the US, some of the same considerations, looking at whether the immigration status or tax residency status changes, also the impact of payroll and tax equalization type items, looking at whether things that are being reimbursed by employers are subject to taxation in the US as a non-resident. And then again, the same comment about the recovery rebate payment and how that impacts the individuals, keeping in mind that individuals that have a ITIN instead of a social security number may not be eligible. And so we need to be thinking about that for on the company side as well.
I know we are right at the end here, so panelists, do you have any additional comments, anything you wanted to add before we sign off?
Yes, I just have a question, Amy. The questions that are in the Q&A, can we get a copy of those so that we can actually respond to the attendees?
Yes, there was a ton of questions that did come in, so we will pull that report and we will answer those questions offline. All right, so you do see our presenters' contact information here on the screen. If you do have any additional questions, we will get your questions answered and we will email out the handout and the links that Anders was mentioning later today. So perfect. Thank you all and have a great weekend.
Take care, everyone. Stay safe.